So, if you're an experienced real estate owner, you know the feeling of building a successful portfolio. But what happens when that very thing you built to create freedom starts to feel more like a golden cage? Well, this explainer is for you. We're going to look at that exact moment when success creates a new, much more complex problem, not with your properties, but with the very structure that holds them all together.
And this quote, it really nails it, doesn't it? Look, your properties are probably performing well. They're great assets. The challenge isn't the real estate itself, it's the way you own it. And that's a weird place to be, right? Proud of what you've built, but kind of frustrated by your situation. It's a paradox a lot of long-term owners face, where the very thing that created all this wealth starts to limit your flexibility and create these risks you never saw coming.
Okay, let's talk about that turning point. You've probably spent years, maybe even decades, building your portfolio. And hey, the strategy worked. But for many owners, there's a moment where that feeling shifts. The portfolio that once felt like your ticket to financial freedom starts to feel a lot more like a complex business you never actually signed up to run. And this right here, this is what we could call the organic growth problem. I mean, portfolios are rarely built with some grand master plan from day one, right? You buy a property, then another one, and another. And over time, what started as a pretty simple passive investment morphs into this huge management-heavy operation. Your equity grows, sure, but it's all tied up, and your ability to make a different move just shrinks. So this feeling of being constrained, it's not just in your head. It's actually a symptom of some very real underlying risks that often go completely unexamined until it's way too late. So let's do a little diagnosis here and look at these hidden structural risks one by one. First up, equity concentration. It's a simple idea, but it is so critical. Think about it. Your entire portfolio's value might be tied up in just a handful of buildings, and they're probably all in the same city. That means one major roof repair, one problem tenant who won't leave, or one little dip in the local economy can have a massive impact on your entire financial picture. Real diversification means making sure no single asset has that much power over your wealth. And then there's the key person risk. And let's be honest, that key person is you. Yeah, you might have property managers, but the final calls, the big strategy, the key relationships, it all comes back to you. So what happens if you want to take a 6-month trip? Or you have a health issue? The portfolio might look strong on paper, but it's actually operationally fragile because it all hinges on one person. Okay, this one is a big one. Tax lock-in. Your properties have appreciated like crazy, which is great. But all those unrealized capital gains, they create this huge reason not to sell. You know that the second you sell an asset, a big chunk of that money is going straight to the taxman. And this effectively handcuffs you to your past decisions, stopping you from jumping on better opportunities that might exist today. And finally, let's talk about the long game, succession. Trying to pass on a collection of individual properties to your heirs is, frankly, an administrative nightmare. What if they don't want to be landlords? And if they have to sell everything just to get the cash, it triggers that massive tax bill you've spent your whole life trying to defer. The way you own your properties can make a smooth transition almost impossible. So when you're staring down these risks, what do most owners do? They look at the traditional ways out. But as we're about to see, these common solutions often fix one problem just to ignore or sometimes even make worse all the others. This table here really just lays out the whole dilemma. You could sell everything. Great, you get cash, no more management headaches, but bam, you trigger a massive tax event. Okay, so maybe you refinance to pull some equity out. Well, that just adds more debt and does absolutely nothing for your concentration risk. Outsourcing management, it helps with the day-to-day for sure, but the structure is the same and you're still the one on the hook. And selling off properties one by one, that's just the same tax problem in slow motion. None of these really solve the structural issue. And this brings us to a really fundamental shift in thinking. What if the goal wasn't to get rid of your assets, but to change the way you own them? It's about evolving your ownership structure so that it matches the maturity of your portfolio. And this is where a concept called a roll-in comes into the picture. Now, here's the most important point. This is not a sale, it's a contribution. You're basically exchanging your direct ownership of a single property for units in a bigger, more diversified fund. You keep your economic exposure to real estate, but you totally change the legal and operational structure. So let's break down what that actually means. On the what changes side, it's pretty significant. You don't hold the title anymore, you give up direct management control, and you're now invested in a diverse portfolio. But what doesn't change is just as important. You're still invested in real estate for the long term. You still have all the underlying market risks that come with it. This is about restructuring your ownership, not about escaping risk completely.
Now, to make this a little less abstract, let's just look at a common model. There are specialized real estate funds out there, especially in the multifamily world, that are designed to do exactly these kinds of transactions. It's a real-world application of the concept, where owners can contribute their assets in exchange for units in a professionally managed, diversified portfolio.
Okay, let's be perfectly clear. This is not a magic bullet. This path involves some serious trade-offs and decisions that are, for all intents and purposes, irreversible. So it is absolutely essential to go into this with a clear and, frankly, a skeptical mind.
And here it is. This is the trade-off in its simplest form. You are giving up control. You exchange the autonomy of being the one who calls all the shots for the benefits of diversification, professional management, and a much simpler structure. For some people, that loss of control is a total deal breaker. And for others, it's a profound relief. So who might this be a fit for? Generally, you're talking about long-term owners who are just ready to step away from the day-to-day grind. They're often thinking about succession, they want diversification, and they see the value in professional oversight. They're trying to solve those structural problems we talked about earlier.
And just as importantly, who is this not for? Well, if you need cash in the near future, this is not it. If you want to be the one calling the shots on your properties, this is not for you. And if you're not ready to operate within the rules and governance of a fund, it is absolutely the wrong path. This is a structural shift for the long haul, not some kind of quick fix. You know, the goal of this whole explainer isn't to give you the answers. It's really to arm you with a better set of questions. It's about helping you look at your own portfolio, not just through the lens of performance, but through the lens of its structure. So think about this for a second. Your buildings, they're made of concrete and steel. They're built to last. But is the legal and operational framework that's holding them all together just as strong? Can it really withstand the pressures of time, of transition, of all the unexpected things life throws at you? And here's a bigger question, one that goes beyond just your own lifetime. The structure you have in place today directly impacts whether the wealth you've built can actually be preserved and passed on effectively. It forces you to think not just like an investor, but like a steward of that wealth. And finally, this might be the most powerful question of all. Doing nothing? Well, that isn't a neutral choice. It's an active decision to stick with the current structure, with all of its built-in risks, the concentration, the tax lock-in, the operational fragility. Projecting that path forward, really thinking about where that leads, that is the first step toward building a truly durable strategy.